Over the past week, dividend stocks have sold off quite heavily because of fears of stickier inflation, which could lead to a higher for longer interest rate environment. The Schwab US Dividend Equity ETF, which is commonly used by investors to measure the performance of dividend stocks, dropped by 6% since the beginning of April, and many of the smaller and lesser known dividend stocks have dropped by quite a bit more than that. This is especially true for companies that operate in sectors that are today out of favor, such as REITs, financials, banks, and so on. Many of those dropped by closer to 15% over the past weeks. I think that this is a buying opportunity because I believe that the real-time inflation is quite a bit lower than what's currently reported. The last month's headline CPI was 3.5%, which may seem concerning, but it was only this high because they had shelter inflation at 5.7%, and this makes up a huge 36% of the CPI index. But in reality, last month's shelter inflation was nowhere near 5.7%. Anyone who closely follows the housing market will be able to tell you that the apartment sector is today oversupplied, and most apartment REITs, including Mid-America Communities, Camden Property Trust, Essex, Avalon Bay, they have all guided for stagnating or even slightly declining rents in 2024. Therefore, the real-time inflation is quite a bit lower than the headline inflation, and the only reason why it's remaining so high and seems to be sticky is because the way they calculate shelter is lagging. According to Trueflation, the real-time inflation is today about 1.8%, and it's been around 2% for a while now already. Therefore, I continue to think that we are likely to see cuts to interest rates in the near term because while the nominal rates may not seem particularly high from a historical perspective, the real interest rates, which are adjusted for inflation, are quite high, especially for today's environment. According to the Fed Watch tool, there is now a 96% chance of at least one rate cut within a year from now, and by September of next year, we are likely to see interest rates that are 100 to 150 basis points lower than today. This bodes really well for dividend stocks that are today discounted because of fears of a higher for longer environment, and therefore I'm buying the dips. Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to talk to you about two of my favorite non-REIT dividend stock investments to buy in April of 2024. But before I get started, I want to remind you that you can access my entire non-REIT portfolio. So what I mean by this, it's my stocks, my bonds, my MLPs, my BCDs, and so on by joining High Yield Investor, which is my income newsletter for a 2-week free trial. I'll put a link to it in the description of this video. So the first company I want to highlight here is called Brookfield Renewable Partners. Its ticker symbol is BEP. It's managed by the private equity giant Brookfield, which also owns about half of the equity of Brookfield Renewable Partners. Its portfolio is today mainly invested in hydro, in wind, in solar, and other renewable assets. The company has an exceptional track record, having managed to grow its FFO per share, which is the equivalent of the free cash flow per share for listed real estate companies, by 12% annually since going public. And when you combine that with its high dividend yield, its total returns have outpaced that of most other stocks and indexes, including the S&P 500, but also Warren Buffett's Berkshire Hathaway, Walmart, Realty Income, and most other stocks. And I think that they can keep this going. Today they have a fortress balance sheet with a BBB+ investment grade rating. Their debt maturities are long at 12 years, and so they are barely affected by the surge in interest rates. Moreover, its revenues are now contracted for 13 years on average, which should result in highly consistent and predictable cash flow going forward. And these contracts are also tied to an inflation index, which should lead to steady growth going forward. Finally, they also have a very large development pipeline that's today costing them money and not producing cash flow, but as all of this comes online, they should see a nice boost to their current revenues. Therefore, the company is confident that they can keep growing their FFO per share by over 10% annually, but despite that, the share price of the company has crashed and even dipped further over the past weeks. Now in total, it's down over 50% from its peak, and as a result, it's today priced at one of the lowest valuations in the company's history, trading at just around 11 times its cash flow, which is down from 21 times for its 3-year average. Its dividend yield now also surpasses 7%, and that's despite having guided to grow its cash flow by over 10% annually going forward. And so I really like this opportunity because if interest rates remain at today's high levels, yes, the upside potential may not be as significant, but you're still getting a 7% dividend yield. You add to that 10% of annual cash flow growth, that should easily get you to double-digit total returns, probably close to 15% annual total returns, which would be in line with its historic average. And if interest rates return to lower levels, as I'm predicting, then it should also enjoy some upside. Just repricing closer to 16, 17 times FFO would unlock about 50% upside, and the stock will still remain discounted relative to its 3-year average. And I would add here that I just don't know many REITs that offer a 7% dividend yield, have prospects for over 10% growth on a per share basis, have strong investment grade rated balance sheet, strong inflation protection, an exceptional track record, and so on, everything that I mentioned earlier. I just don't know many such opportunities, and for this reason, this is one of my favorite non-REIT stocks to buy today. Before I go into the second company, can you please do me a huge favor and click the like button? That will help me a lot to grow this channel. Thank you so much in advance. And also subscribe if you don't want to miss updates on any of these companies in the future. The second company, I've discussed it previously on this channel, is called Patria Investments, ticker symbol PAX. This is arguably my favorite buy the dip opportunity today, and I'm now going to give you an update. Over the past weeks, the company's share price dropped by about 15%, and that's despite continuing to grow at a rapid pace, having barely any debt, and so it's not heavily impacted by the surge in interest rates, and it also posted some good news for shareholders. So there's a very big disparity between the fundamental performance of the company and its share price performance, and since I cannot make sense of it, I'm buying the dip. For those of you who are not familiar with Patria, this is an alternative asset manager just like BlackRock, Brookfield, KKR, Blue Owl, Carlyle, and many others. They all earn fee income for managing investments for others, and they all have their own specialization. Blackstone focuses mostly on commercial real estate, KKR mostly on private equity, Brookfield on infrastructure, Blue Owl on private credit, and in the case of Patria, it focuses mainly on Latin American markets. It is the leading private equity company in this region, and it's been very successful at growing its assets under management as well as its fee income. I'll put a chart here on the screen, and you'll see there that it has grown its assets under management as well as its fee income by about 30% annually since going public. And I expect this strong growth to continue because Latin America is becoming increasingly attractive for international investors because of several reasons. The first reason is geopolitical uncertainty, because today we have big wars in Europe. Russia has invaded Ukraine. We also have a big war in the Middle East at the moment, which might be escalating, by the way. And we also have growing risks of potential conflicts in Asia, with China potentially invading Taiwan in the future. In that context, Latin America stands out as a potential safe haven. It was so already during the Second World War, and now increasingly many investors want to allocate a portion of their portfolio in Latin America to diversify their portfolio, because the performance of these markets has historically been uncorrelated with the rest of the world. The second reason why I expect rising allocations to Latin America is the growing trend of nearshoring. Many Western companies are today learning the hard way that dictatorships like Russia and China cannot be trusted, and they are now reconfiguring their supply chains to bring back larger portions of them to their home markets or close to them. As a result, a lot of American companies are today heavily investing in Central and Latin America, and I expect this to continue. And then the third reason why I think that Latin America is today still quite attractive as an investment destination is that these markets are quite fragmented, they are less competitive, and as a result, valuations are quite a bit lower and opportunities are abundant, especially for highly sophisticated players like Patria Investment. And so this is a great environment for Patria to keep growing its assets under management as well as its fee income, and this is well reflected in its latest results. In the last quarter, the company's fee-related income rose by another 31%, and if you analyze this fee income, it gets you to $1.25. And so if you now look at the share price and you deduct all its accrued performance-related fees from it, the company is today essentially priced at just 8 times its fee-related income, which is, to my knowledge, the lowest multiple in the asset management sector if you only consider these big players that are leaders in their respective fields. It's a much cheaper valuation than that of Blackstone, Brookfield, and so on, and that's despite having close to no debt and growing at a faster pace. In the last quarter, they also realized quite a lot of performance fees, and that resulted in them announcing a pretty big dividend. If you annualize it, the dividend yield is currently 12%. And while I'm talking about the dividend, it's interesting to note that because the company is structured in the Cayman Islands, there shouldn't be any withholding taxes for investors, but make sure to check that with your own broker. And so here again, I want to ask you, how many companies you really know that pay such a high yield while enjoying such rapid growth prospects and having such strong balance sheets that aren't heavily impacted by the surge in interest rate? I just don't know many, and for this reason, I'm heavily invested in Patria investments. So there you have it, Brookfield Renewable Partners and Patria Investments are two of my favorite stocks to buy in April of 2024. But there are many other companies that I'm buying at the moment because the recent dip has led to a lot of opportunities. And if you want to access my entire real money portfolio, you can join High Yield Investor for a 2-week free trial. I'll put a link to it in the description of this video. As I've noted before, this is a real 2-week free trial, which means that you won't be charged anything in the first 14 days. You can join the service, see if you like it. If it's not for you, as long as you cancel in the first 14 days, you won't be charged anything. And then finally, once more, if you could please click the like button, that will really help me a lot to grow this channel. Let me know if you want me to keep producing more non-REIT related content in the comment section below, and also subscribe to the channel if you want to support me. Thank you so much in advance. See you at my next one. Bye-bye.